Hello dear fellow valuers. So today we are going to start with second session on market approach to valuation. In today's session we are going to discuss about various methods of sales comparison techniques. So this is the IBBI syllabus for 7 marks theory and up to 20 marks of numericals can also come out of this session, this series of 5 sessions. Sales comparison method. This is a popular and common valuation methodology for real estate valuation. So the sales comparison approach can be particularly helpful when property does not generate any lease income or that information is not available. Either the property is not generating any type of income, lease income, or if at all it is generating, that information is not available to the valuer. And thus this method estimates market value for a property using recent sales data from other similar properties, substitution of the properties. So we collect sales data and income data pertaining to the nearby properties, and based on that we try to estimate and calculate market value of the property which is required to be valued by the valuer. So this approach is generally recommended for non-income fetching but marketable properties. So 1 mark question can come out of it. Non-income fetching plus marketable, right? We had discussed the concept of marketable and non-marketable properties in previous session. Sales comparison method is based on principle of comparison and substitution. So we try to identify properties which are comparable to the subject property which is required to be valued by us, and then we collect data pertaining to those comparable properties, and then we adjust those data for the property which is required to be valued, and then we calculate the value of the subject property. Let us see how do we calculate using various methods of sales comparison method. So there are 5 main techniques of sales comparison method. Adoption of weightages, hedonic pricing model, it is also called quick and ad hoc comparison technique, adjustment grid model, price quality regression technique, and 5th one is weightages score system. So as per IBBI syllabus, only 3 techniques are covered. So we'll try to cover these 3 topics in current session along with the case studies and examples. First method of sales comparison method is adoption of weightages. It is also called weightages for land comparison. So step 1 of this method is to do valuation through this technique. Valuer should decide some attributes for the open land of sample property sale data and make necessary adjustments. For example, these are the attributes for subject land which is required to be valued. So attribute of subject land to be valued, and then let us see attribute of sale instance plot. So whatever sample data we have, so these are the attributes for the sale instance, and we have to make some adjustments based on the attributes of the subject value vis-a-vis comparable attribute of the sample plot. So for example, the plot which is required to be valued by us is of double frontage, and the sales instance data we have sample property whose data we have collected for valuation had single frontage. So the property which is required to be valued by us would have higher valuation because of this parameter, maybe say 15 to 20% we can assume. Then if a plot which is required to be valued by us is of large size, however the plot size of the sample property was of small, so normally very large size plots carry less property value, so we may discount property price by 15 to 40%. Then time factor for current year. So basically the property which is required to be valued might be, we are planning to sell it, so we do valuation as of as on current date. So the property, the sale data we have considered might be sometime old, say 1 year before. So we may expect certain price escalation, capital appreciation in the property in last 1 year, maybe from 5% to 15% depending on the market conditions. Then main road, the property which is required to be valued or subject property is on main road, but the sample property was on by lane. So our existing property would fetch higher valuation maybe from 15 to 40%. The property which is required to be valued is landlocked, right? But in the previous sample property was a plot abutting road, so it was not landlocked. So it will affect, it may reduce valuation of our sample subject property up to 70 to 75 to 80%. Then joint ownership. The property, existing property which is to be valued is under joint ownership. We have discussed the concept of co-ownership and joint ownership, flat ownership, different type of ownerships in our previous session. However, the previous sample data property was under single ownership. So as a more number of owners exist, come into picture of a sale transaction, so normally value of property decreases. So in this case, property value may decrease from 5 to 15%, let us say. So the property which is required to be valued is falling on a low-lying land. However, the previous sample data property was on a level ground. So we may deduct amount for filling of the land in case of existing property valuation. So the property which is required to be valued is on sea front. However, the previous property sample property was away from sea. So if the it may have negative or positive both effects on the property valuation. So if our existing property is very near to sea, so because of higher wear and tear, it may cause reduction in value, maybe up to 20%. However, if it is at reasonable distance from the sea, so because of vista, because of sea view, that property, that plot may carry higher land rates, maybe up to 30%. So if there is let us say some litigation is pending, court stay is there against sale of the existing property, which is required to be valued by us. However, in case of sample property data, there was no litigation, right? So it may causes up to 30% reduction price of the property, which is to be valued by us. So forced sale by authority. So existing property which is required to be valued is a kind of forced sale by authority or bank. However, the previous sale data which we have collected from the market, that was a normal market transaction. So in such a scenario, our property will fetch lower value, maybe up to 15 to 30%. So next step, step number 2 of this method is, then we have to calculate following 3 data for each of the sample properties. So whatever 2, 3, 4 samples sample data property we will collect from the market. So we have to first calculate potential gross income, income from before deduction of any expenses which a property is likely to generate, assuming 100% capacity utilization. Say if a house is having, say if a building is having, say 10 flats or 10 rooms, and rental value of then we have to assume that all 10 rooms are fully occupied throughout the year, and accordingly we'll try to calculate the potential gross income, assuming 100% capitalization capacity utilization of the property. So effective gross income. So once we calculate potential gross income, and if we deduct deduction for vacant area or vacancy, so it is quite possible that for some part of the year that property may remain vacant and we may not generate some income out of it. So practically it is not possible that we will get 100% occupancy throughout the year. So it may be 90%, 80% or 95%. In certain cases it may be 100% also. So whatever income we have actually generated in past years from the data, that is the effective gross income, and it is equal to potential gross income as calculated here minus deduction for vacancy. So based on actual capacity utilization of the property, we calculate this figure. Then we calculate net operating income. Third data we have to calculate for all the sample properties is net operating income. So out of effective gross income we have to deduct operating expenses. What are operating expenses? Like whatever charges a landlord or lessor is supposed to pay. For example, normal charges, outgoings we have already discussed in the previous sessions, but just to reiterate, like land tax, NA tax, insurance, house insurance. So these expenses are normally being borne by the landlord. So these are the operating expenses which are required to be deducted from the net operating income, from gross income, to arrive at net operating income. The next step of this method is step number 3. After identifying attributes of the subject land and deciding about their weightages, calculate following market indicators. So in whatever attributes we have identified as per step number 1, and then we have to make necessary adjustments in per square feet land rate of the subject property. Then we have to calculate adjusted per square feet rate of sample properties data collected. So don't worry about this theory thing. We will try to understand all these steps with the help of a case study, which we are going to discuss in subsequent slides. So just have a look of this formula and try to understand. So first step in step number 3 is that we have to calculate adjusted per square feet rate of the sample properties. So if say we have 3 properties, so we have to adjust their per square feet rate by adjusting for weightages for the various attributes of the property, as we discussed in this step number 1. Then we have to calculate adjusted potential gross income multiplier. In short form it is called PGIM. So how to calculate adjusted sale price? So adjusted sale price we will get from here, adjusted per square feet rate into area, and then potential gross income. This we calculated in the step number 2, right, for each property. So for each of the sample property we have to calculate adjusted PGIM. Likewise we have to calculate adjusted EGIM for each of the sample properties, which is equal to adjusted sale price, which is equal to adjusted per square feet rate of the sample property into area of the said sample property divided by effective gross income, which we calculated in step number 2. Then third, we have to calculate adjusted capitalization rate for each of the sample property, which is equal to NOI, net operating income of each of the sample properties, divided by adjusted sale price of the sample property. So adjusted sale price we have equal to adjusted per square feet rate into area of the sample property. Then step number 4, calculate average of following 4 market indicators. Whatever 4 market indicators we have calculated in step number 3, say we have calculated these market indicator for 3 or 4 properties, then we have to calculate average of these 4 factors, these market indicators. Number 1, average adjusted per square feet rate, average adjusted PGIM, average adjusted EGIM, and average adjusted R capitalization rate. So after we calculate average, then we have to calculate following 3 data for the subject property which is required to be valued. So now here till here we have done working on the sample data only. So now we'll start working on the property which is required to be valued by us. So likewise, first we have to calculate PGI, potential gross income, then effective gross income and net operating income, as we have calculated in the previous step number 2 of the technique. So after that, calculate following 4 market values of the subject property as under. So value 1 is equal to area of subject property into, so the area of the property which is required to be valued by us. Subject property is means value of subject property means property which is required to be valued by the valuer, right? So area of subject property multiply by average adjusted per square feet rate of sample data, as we calculated in step number 3. Likewise, value number 2 will get potential gross income, as we calculated in step number 4, last step number 4, and then we have to multiply it with average adjusted PGIM of sample data. So potential gross income is required to be calculated with PGIM, average adjusted PGIM of sample data. Then value number 3 we will get effective gross income as right in step number 4, and of the subject property multiply with average adjusted EGIM of sample data from step 3. And likewise, as property value 4 we will calculate as net operating income of subject property, as calculated in step number 3, and we have to divide it with average adjusted capitalization rate, as we have calculated in step number 4. So based on above 4 market values arrived, the valuer can judge the final market value of this subject property. So let us try to understand these steps with the help of a case study. So this is a case study. Calculate value of a new 2400 square feet office property. Market rent of the area is rupees 15 per square feet, with average operating expenses of rupees 4.1 per square feet and average vacancy of 6%. So this all data is pertaining to the subject property. There have been 3 similar properties which have been sold during last 18 months. So we have as a valuer we have been provided with data of the 3 sample properties pertaining to last 18 months. The sale data of these 3 sample property in vicinity of subject new house is as under. So first, property number 1, 2, 3. So these are the attributes and this is the property number 1, 2, 3. So property number 1, sale price was 26.75 lakh. Property 2 was 42 lakh, 19.50 lakh. So these were the prices of sale of sample data. Time of sale, the first property was sold 5 months ago from today. Second property was sold 8 months ago from today, and third property was sold 18 months ago from today. Age of the building, property number 1 was 5 years old at the time of sale. Property number 2 was 3 years old at the time of sale, and property number 3 was 5 years old at the time of sale. Gross building area of property number was at the time of sale was 26,500 square feet. Property 2 46,200 square feet, and property 3 22,300 square feet. Potential gross income, assuming potential gross income means income from the property, maximum income from the property which can be generated assuming 100% capacity utilization of the property. So potential gross income, PGI of property 1 was 3.44 lakhs, PGI for property 2 was 5.92 lakhs, and PGI for property number 3 was 2.27 lakh. So vacancy, property 1 is having a traditional track record of vacancy of 5%. Property 2 remain on an average remain vacant for 6%, and property number 3 it never remained vacant, and almost 100% occupancy is there in the property. Operating expenses for property number 1 99,000 rupees, then property 2 1.72 lakhs, and property 3 0.72 lakhs. So market value in the area has been steadily increasing by about 1% per quarter for last 2 years. So these are the assumptions for doing adjustment pertaining to the various attributes of the sample data. Subject property along with property number 2 and 3 is of average construction quality. So this is the additional information which has been given about the subject property, that subject property and property number 2 and 3 are of average quality construction quality. However, the comparable property 1 is built with above average construction quality. So we have to calculate value of office property by sales comparison method. So as I always say that first of all, please write down the data given in the question, whether it is required for calculation or not, but we should write the data in totality. So data given in the question is area of this new office 24,000 square feet, then market rent is given rupees 15 per square feet, then operating expenses are also given 4.1 rupees per square feet. Average vacancy is 6%, so that means it remained vacant for 6% times and remain occupied for 94%. So property prices have been increasing at the rate of 1% per quarter, and the construction is of average quality of the office building. So this data is given for about the sample properties. This we have already discussed. Sale price is given, time of sale, average building, age of the building, gross building area, potential gross income, vacancy, operating expenses, construction quality. So all these data up to this data has been given in table, and this construction quality data was not given in table. However, it was given in statement. So we have to put this data into statement form, and then we have to calculate price per square feet equal to sale price divided by gross building area for each of the sample property. So sale price is this 26.75, and gross building area is also given in the question, which is 26,500. Since our property is a new property, so we have to increase these prices say by 4%, since the property number 1 was 5 years old at the time of sale, property number 2 was 3 years old at the time of sale, and property number 3 was 5 years old at the time of sale. So since our property is new, so our property will fetch higher prices as compared to this sample data. So we have to increase these prices by say 4% as per assumption. If age of the building is more than 3 years, then we have to appreciate prices by 4%. Then third attribute of the building, subject building and sample building, is quality of construction. So in our case, quality of building, construction quality of building is average. So if say property number was of also average quality, property number 2 was of average quality, and property number 3 was of good quality. So good quality, let us say 0. So we will make -2. So since the property number 2 and 1 were of average quality construction, so we have to reduce prices by 2% to make them to bring them to the average quality construction. So adjusted total adjustment for property number 1 we have to make is 2% for time factor, 4% for building, age of the building, and third minus 2% for quality of construction. So put together 6% price we have to adjust in case of property number 1. Likewise 7%, 10% in case of property number 2 and 3. Then adjusted price per square feet. So per price per square feet we have actual price, and then we have to make adjustment for the factors attributes, which is 4%. So 104.98 is the adjusted price per square feet of sample property 1. Likewise 97.27 for property number 2 and 96.18 rupees per square feet for property number 3. So we can calculate adjusted property value by multiplying this adjusted price per square feet into area of the each of the sample properties, which is given in the question. So 104.98 multiplied by 26,500 square feet is equal to 27.82 lakh is the adjusted sale price of sample property 1. Likewise 44.94 for sample property 2 and 21.45 for sample property 3. Then step number 2, calculate potential gross income PGI and effective gross income EGI and net operating income NOI for each of the sample properties. So PGI is already given in the question for property number 1, 2, 3. We need not to calculate. Then vacancy is given in the question, 5% in case of property 1, 6% property 2 and 0% property number 3. So vacancy is the percentage of time for which the property is expected to be vacant. So it is not going to generate income. So expected gross income is 100% minus vacancy is equal to occupancy, actual occupancy, expected occupancy into PGI. So 95% of 3.44 lakh is the expected gross income EGI. Likewise 94% of 5.92, 5.56, and since in this case there is zero vacancy, so it means the property is likely to be 100% occupied. So PGI and EGI both will be equal. Then we have to deduct operating expenses. It is already given in the question, also given in the question. So operating expenses 99,000 rupees in case of property number 1, 1.72 lakhs in case of property number 2, and 72,000 in case of property number 3. So if we deduct NOI, net operating expenses, from EGI, so we will get from operating expenses from EGI we will get NOI, net operating income. So 3.26 minus 99,000 is 2.27 or 28 lakh rupees of net operating income from property 1, 3.84 lakhs of NOI from property number 2, and 1.15 lakh of NOI from property number 3. So now third step of this method is to calculate adjusted PGIM, adjusted EGIM and adjusted capitalization rate for each of the sample properties. So adjusted property value we have already calculated in step number 1. So just put up all these three figures into a tabular format as given in this slide. Then next we have to calculate adjusted PGIM, which is equal to adjusted property value. This we have already calculated in step number 2, and PGI, potential gross income, which is equal to 27.82 divided by 3.49. All these figures have been calculated in previous slides. So it gives us a factor which is called adjusted PGIM is 8.09 for property number 1, 7.59 for property number 2 and 9.45 for property number 3. Likewise we will also calculate adjusted EGIM, which is equal to adjusted property value divided by EGI. So property value we have given 27.82, we have been calculated in step number 2, and then EGI we have already also calculated, which is 3.27. So we will get the factors 8.51 for property number 1, 8.08 for property number 2 and 9.45 for property number 3. And likewise we will calculate adjusted capitalization rate for each of the sample property using formula NOI of each of the property divided by adjusted property value of each of the sample property. It gives us an capitalization rate of 8.2% for property number 1, 8.5% for property number 2 and 7.2% for property number 3. In step number 4 we have to calculate average of all these four parameters of all these parameters as we have calculated in step number 4. So these are the averages. So average adjusted per square feet rate of the sample properties data is equal to 99.48. It is equal to this figure plus this divided by 3 is equal to 99.48. Likewise, it is arithmetic mean of these three figures. 8.09 plus 7.59 plus 9.45 divided by 3 is equal to 8.38. So likewise 8.68 and average capitalization rate, adjusted capitalization rate of 8% of the sample properties. So till now we have done working on the sample properties. We have adjusted sample property data to make them suitable for the subject properties. So now we have to calculate PGI, EGI and NOI of the subject property as per the data given in the question. So PGI, for calculation of PGI, area of the office is given in the question and market rent per quarter per square feet is also given in the question. So 24,000 rupees per square feet and 15 rupees per square feet. The market rent is given in the numerical case study. So annual potential gross income of the subject property is 3.60 lakhs. Vacancy as given in the question is 6%. So EGI will be equal to 94% of 3.6 lakh, which is equal to rupees 3.38 lakhs. Then we have to deduct operating expenses from the EGI to arrive at NOI, which is equal to 3.38 lakh minus 98,400, which is again given in the question. We can calculate using by multiplying area of the property into per square feet operating expenses of the property as given in the question, and is equal to 98,400. So NOI of the property, subject property, is 2.4 lakhs. In step number 4, we have to multiply these parameters as calculated in step number 5 with the averages as calculated in step number 4. So we have to calculate 4 values of this. We will get 4 values of the subject properties by sales comparison method as enter. So first, average adjusted price square feet. So average of sample data which we had calculated is 99 rupees 48 paisa per square feet, rupees per square feet. So office area of the property is 24,000 square feet, which is required to be valued, and average of the average adjusted per square feet rate of the sample data is 99.48. So based on this parameter, the valuation of the new office subject property should be 23.84 at say 24 lakh rupees. So likewise, if we multiply this average adjusted PGIM of sample data with PGI of the subject property, so that will give us the approximate value of the subject property with the help of PGIM. So 3.6 lakh is PGI of the subject property and 8.38 is the adjusted PGIM of the sample data. So this gives a value of 30.17 lakh, say 30 lakh rupees. Then third factor we had calculated was average adjusted EGIM of the sample data. It was 8.68, and for the subject property EGI we have calculated in step number 5, which is equal to 3.38 lakh into average adjusted EGIM of the sample data is equal to 29.37. So again it is giving a valuation in the range of 30 lakh rupees. So fourth parameter is average adjusted capitalization rate of the sample property, which we had calculated as 8%. So NOI of this property we have calculated in step number 5, which is equal to 2.4 lakhs, and average adjusted R of sample data is 8%. So if we divide NOI divided by average adjusted R, we get a value of the property of subject property is approximately 30 lakh rupees. So thus the value of subject property ranges from 24 to 30 lakh rupees. Since 24 lakh is much lower and remaining three values are in range of 30 lakh rupees, so valuer may go ahead with 30 lakh rupees. So as a valuer we can say 30 lakh rupees is the estimated fair value or fair market value of the property. So next method into sales comparison method is ad hoc comparison method, or it is also called hedonic pricing method or hedonic pricing model. So this has been most popular sale comparison method used by valuer for last many years. Many valuers use this technique to save time and to give quick valuation report. Under this model, price of property is expressed by following formula. So price of property in market, which is equal to P, is function of STLA. What are these? S is size or covered area of the premises of the building. So demand for large area is less than that of small area. So normally properties with larger land area or built up area have less demand than small area from buildings. So next is time factor at which asset is traded in the market. So demand and supply position and environment of real estate market at a particular point in time. So it also affect the valuation of the property. Third parameter of property valuation is location of the property. So proximity to civic amenities, and fourth parameter which we consider in this model is age or physical condition of the property, applicable for building only. So in case of open land, this factor will not be applicable. So what are the steps to be followed by valuer to calculate value using this method? First step is valuer collect data of sale instance in nearby locality as of relevant time period. So non-genuine sale transactions are excluded. So first of all, as a valuer, we have to calculate data for a specified period from the market about the properties, similar properties. Then rates and attributes of genuine sales are compared with the attributes of such property. Then we compare rates and attributes, 4 attributes. Here we discuss about only 4 attributes. All relevant factors and weightages applicable are recorded. Hedonic model consider only 4 attributes in spite of the fact that there are multiple factors which are also applicable. So please note that thing that in method number 1 we had used, we had considered number of factors, attributes, but here in Hedonic model we consider only 4 models. Just to easily remember these 4 things, I used to remember these 4 factors by using the word SALT, TLSA or SALT, right? So you can use SALT. So likewise you can also remember these 4 words, keywords, that these are the 4 factors which you have to consider for doing valuation through Hedonic model. Then third step of the process is valuer then arrives at concluding overall effect of these comparisons. It may be positive weightage over sales instance or negative. So first we decide the factors, which are the factors applicable on the property inferior superior. Then we have to adjust weights of the price as compared to subject property. So valuer then finally estimates the final rate for the subject property based not only his experience but expertise, but also on the basis of overall impression. So this is called ad hoc analysis. This is also this technique is also called ad hoc analysis, in fact. So let us try to understand these steps with the help of an example. A real estate company follows hedonic valuation model to value houses in a particular area. The characteristics of the property that affect its price are as under. So this is the model which has been adopted by the company. So number of rooms per unit of room is rupees 10 lakh rupees of slope coefficient per unit. Then surface area of the garden, second parameter, second characteristic, unit is per square feet rate. So rupees 10 per square feet slope coefficient. Then swimming pool, rupees 10 lakh per swimming pool is slope coefficient. And distance to shopping center is minus rupees 5,000 rupees per kilometer distance from the house per unit. The company wants to arrive at valuation of the property that has 6 rooms, a 3,000 square feet garden and a swimming pool, and a shopping center is 3 kilometers away from the house. The data given in the question is that the subject property has following 4 characteristics: 6 rooms, it has 4 rooms, 6 rooms, 3,000 square feet of garden, 1 swimming pool, and distance of the property from district shopping center is 3 kilometers. So if we calculate the solution, then in the subject property characteristic, we have the subject property has 6 rooms. So per room slope coefficient is 10 lakh rupees. So value of total 6 room is 60 lakh rupees. It will give a positive value of 60 lakh rupees to the value. Then this property has a 3,000 square feet of garden area also. So since slope coefficient of rupees 10 per square feet is been given in the question, so total value of the garden which will add up to the property valuation is 30,000 rupees. Then the property also has 1 swimming pool. So 10 lakh rupees per swimming pool has to be added. So 10 lakh rupees straightforward will be added to the property value. And since the property is 3 kilometers away from the shopping center and the slope coefficient which company follows is minus 5,000 rupees per kilometer distance from the shopping center. So 3 into 5,000 is 15,000 rupees of negative value will be, it will be deducted from the total property value. So total property value using the Hedonic model will be 70.15 lakh of the value property. Third model is adjustment grid model. This method is similar to ad hoc approach or Hedonic model, but this model is less ad hoc and more scientific, as here valuer can select more than 4 parameters and attributes. So in previous case we had selected, we had fixed only 4 parameters, but however in this case we can, as a valuer, we can select more than 4 parameters or attributes. The valuer should have sound logic and data for assumptions regarding weightages assumed for various attributes. So while doing, however, in case of numerical questions and case study for IBBI exam purpose, all these assumptions will be given in the question. However, in practical scenarios, whatever assumption we make for to arrive at the valuation through this model, so we should have some supporting document logic and basis documented logic for that assumption, and we should keep that logic into record of our file. After selection of 4 or more attributes, each attribute should be given following ranking. So first we have to decide a number of attributes, then we have to decide their quality or weights. We have to give ranking. So ranking 5 normally we give for best quality attribute, then ranking 3 we give for medium quality attribute, and ranking 1 we give for poor quality attribute. Thereafter necessary weightages should be allotted to each rank, keeping rank of subject property into consideration. So if I say I consider my subject property as a base property, and based on that property I used to keep rank the sample data based on this 531 best, medium and poor quality attribute. Just to understand the concept of ranking, relative ranking of the properties on various attributes, we have made one small table just to make this understanding easy and clear. So these are the 4 attributes. Say location factor is the first attribute. So if the property is situated at best location and all civic amenities are located nearby, so on this parameter this property can be ranked 5. And if the property is situated at average location, say civic amenities available up to 1 kilometer distance from the property, so we can rank those properties on this parameter as rank 3. Then if the location of the property is poor, say no civic amenities available up to 1 kilometer or beyond that, then we may rank the property rank 1, poor property, poor location. So likewise other parameters, small size plot say may be ranked 5, best, it is better, it is good. So areas up to 75 square meters, say we can make a cutoff 60 square meter or 75 square meter. Then mid size plot, say up to 75 areas square meter to 120 or 150 square meter. Then large size plots may be ranked as rank 1. So ranking 5 is best. Just to reiterate, ranking 1 is poor. So large size have poor marketability as compared to small size. So plot areas or size of the properties or built up area of the flats having more than area of 120 or 150 square meter may be ranked as 1. So likewise age of the building, young buildings maybe say up to 10 years of age can be ranked best, which is rank 5. Then medium age building, 10 to 30 years of age building may be rank 3. Then beyond 30 years of old building may be ranked as 1. Specification of building could also be another parameter or attribute. Good specification, say with vitrified tiles, may be ranked as given rank of 5. And then average specification maybe with ceramic tiles may be given score of 3 or rank of 3. And then poor specification, quota stone and mosaic tile, for example. These are indicative attributes and indicative examples you can have as a valuer of your own cutoff limits depending on the local market research. However, in case of numerical, all these assumptions will be given clear cut in the question, so that you can need not to make any assumption. So before doing weightage adjustments, time factor adjustment to per square feet need to be done. So let us understand this technique with the help of a case study. So a residential flat is situated on the first floor of a building which is 6-year-old. A residential flat is situated on first floor of a building which is 6-year-old. So age of the building is given. The building abuts on major road. It is the second information is given. It is abutting the major road and is situated in close proximity of a shopping, recreation and cultural center. So civic amenities are available nearby. The flat is finished with best specification. So quality of construction is given with marble floor and good internal planning. So area of flat area is given 65 square meter. Find market value of the flat today on the basis of comparable given below. So 3 sales instances have been given. Data of 3 sample property has been given, and we have to, with the help of that sample data, we have to calculate market value of the subject property whose details are given here. So property is sample property number A is a sale number A. A flat measuring 125 square meter at first floor sold at 38,000 rupees per square feet about 5 months back. The building is 15 years old and is situated on secondary road but close to shopping complex and recreational center. This flat is of standard specification and mosaic floor. So all parameters which can be compared with parameters of subject property are given for the sale instance 1. So sales instance B, a flat measuring 90 square meter at first floor sold at 30,000 rupees per square feet about 10 months back. The building is 22 years old and is situated in a middle class locality on narrow lane. So this is a location away from shopping complex and recreational club. So this is about location. So here is age, this is rate per square feet, and this is the flat area, and this is the time of the sale. This flat is of poor specification. This is another attribute given in the question. And sale instance 3, a flat at measuring 100 square meter at first floor sold at 42,000 rupees per square feet about 6 months back. So here area has been given and again time has been given, 2 attributes have been given. Then building is of 10 years old, third attribute is given, and is situated on major road surrounded by first class income group occupier but away from shopping complex and recreational and cultural center. So again location attribute has been given. This flat is of superior quality, most specification, superior most specification with marble flooring. So next another factor, another attribute has been given on the property. First step of the solving the problem is that we have to put all data which has been given in statement format in a tabular format for easy understanding and solving the problem and for doing the ranking of the data. So first column will put up the attributes of the property, then subject property, second column, third column property number A, property B, property and C. So sale data is rate per square feet of the property. So in first column put question mark just to easily remember that we have to calculate this figure in the examination or question. For sale property, sale data or sale property number A, B and C, these per square feet rate, actual sale price or per square feet rate of these three properties have been given in the question. So please note down these data in the question. Then area of subject property and the three sample property has been given in the question. So our subject property is having lowest area 65 square meters. So if we refer the previous ranking table, indicative ranking table which is given in the session, discussed in the previous slide of the session, so this property will get highest rank of 5. However, property number A is having 125 square meter of area, so it will fall in third category of poor area, so it will give a lowest rank of 1, and other two properties 90 and 100 square meter will fall in second category of the area segment, so it will give a middle ranking of 3. Age of the building, our building subject property which is required to be valued is of young age, it is less than 10 years, so it will be given a rank of 5. Best rank of 5. However, other three properties are greater than equal to 10 years and up to 30 years. So all three properties will be given average ranking of 3. So specification, our property and property number 3, both are having best specifications, very good specifications. So these two, both the properties will be given best ranking of 5. However, property number A is of standard specification as given in the question, so it will be given average ranking of 3, and property number B is of poor specification, so it can be given a ranking of 1. Location, subject property is having good location and is on main road, so both factors are good, so it is on location is very good, so we can give ranking 5 to this property. However, in case of property number A, the property number A is close to civic amenities, however it is not on major road, instead it is on secondary road, so it is of average location, so middle ranking can be given rank 3. In case of property number B, it is away from shopping center and narrow lane, so both factors are negative, so it is a poor location, so we can give rank of 1. And property number C is away from civic amenities but is on major road, so out of 2, one factor is good, so we can say location of the property. Third property is property sale instance 3 is of average location, and we can give rank 3 to this property. So subject property is required to be valued as on current date. So and however, sale instance A happened 5 months back, and sale instance B property was sold 10 months back, and C property was sold 6 months back. So step 2, after calculating the average relative ranking of these three properties, so we have to valuer may assume 1% rise in sale price on monthly basis in case of flat based on local inquiry. So it is subjective. However, in case of IBBI exam question, the assumptions will be given in the question. in practical scenario you can make certain assumptions based on local inquiry, and in case of land, monthly rise of 2% per month may be assumed. Thus time adjusted sale data to be calculated as under. So sample property per square feet rate was 38,000 rupees per square meter, sample property per square feet rate was 30,000 rupees per square meter, and property 3 was 42,000 rupees per square feet meter. So we have to, first of all, we have to adjust these rates with respect to time. So first property was sold 5 months back, so let us assume 1% per month rise for the property. So time adjusted sale price of the property will be 38,000 into 1.05, 5% appreciation, capital appreciation for 5 months. So it will be 39,900 per square meter. And in case of property 2, the appreciation for last 10 months is likely to be 10%. So current value of the time adjusted sale value of property 2 is 33,000 rupees per square meter. And in case of property 3, since it was sold 6 months back, so a capital appreciation of 6% is expected. So property value per square feet rate of the property C is 44,520 rupees. So after calculating time adjusted sale price, we have to do assign weights for each property and each attribute for each sample data property. So first attribute is size. So the subject property which is required to be valued is having a ranking of 5. However, the other property is property number 1 is having ranking of 1. So it was having a poor ranking on attribute. So just to make it better, just to make this ranking comparable to the ranking of subject property, we have to give price escalation of say 10%. In this case, all these assumptions will be given in the question. You have to put in this data. So property number 2 and 3 both are having a ranking of 3 as discussed in previous slide. So we have to increase property prices of these properties at least by 5% to make them equivalent to attribute of subject property. Likewise, age. Let us say 0.5% per annum weightage is been given for age in terms of depreciation. So since our property is 6 years old, however property number 1 is 15 years old, so there is a gap of 9 years, right? So total 4.5% of weightage will be given. We have to increase property prices of property 1 to make it equivalent to age of the property, subject property, which is to be valued, and that is 9 years into 0.5% is equal to 4.5% price has to be increased for property 1. Likewise, 22 years is the age of the property and subject property is 6 years old, so 16 years is the gap between the two properties. So to meet out that gap, we have to increase property price of property 2 by 8%. Likewise, in case of property 3, we have to increase property price by 2%. Because third property was 10 years old and subject property is 6 years old, so age gap is 4%, 0.5% per annum depreciation per annum weightage we have to give. So 2% price increase we have to do to match these two figures. Then third parameter is specification. So subject property which is to be valued is having best specification, ranking 5. However, property 1 is having average specification with ranking 3. So we have to improve. So this ranking is high. So we have to increase property prices from at least by 10% to make it equivalent to best ranking. Likewise, in case of property 2 is having a ranking on specification in terms of specification of ranking 1, which is poor ranking. So we have to increase property prices by 15% to make it equivalent to best ranking. In case of property 3, that is superior, so it was having best ranking of 5. So rank of subject property and property number 3 are same on this parameter. So there is no requirement to make any price adjustment. Nil weightage will be given to this parameter for property number 3. And fourth parameter is location. So location of our property, subject property, which is to be valued is best. However, property 1 is having 3 locations, so we have to improve it by 10%. We have to increase price of property 1 to meet the parameter by 10%. Here in case property 1 is having poor location, so we can increase price of this property by 20%, and property number 3 is again having average location, average ranking for the location, so we have to increase 10% of this property price to make it equivalent to subject property. Then after assigning all these weights, we have to calculate total weight. So total weight for property number 1 is 10% plus 4.5% plus 10% plus 10%, that is equivalent to 34.5%. So if say this property is having 100 rupees, so 134 rupees 50 paisa will be the equivalent price which is adjusted to the subject property. So here in this case 5% price rise for size factor, size attribute, 8% for age attribute, 15% for specification attribute, and 20% for location attribute. We have to increase by plus 48%. That is the total weight of adjustment. It can be negative also in certain cases if our property is inferior to these properties. So in property number 3 is 17%, which is equivalent to 5% plus 2%. Third parameter was 0. There was no weight was assigned because third parameter is same to this weight property, and location is 10%. So 17% weightage total weightage has been given to property number 3. So after that we will calculate final adjusted rate per square feet per square meter, which is equivalent to time adjusted sale data, which we had calculated in step number 2 into 1 plus total weight. So this 39,900 rupees per square feet rate of time adjusted time rate, adjusted time sales rate, we had calculated in step number 2. So we have to multiply this time adjusted rate with the further weights which we have calculated in the table. So that will give us the rate of the market. So 53,666 rupees for property 1, 48,800 rupees property 2, and approximately 52,000 rupees in property 3. So we can, as a valuer, we can conclude that final adjusted rate per square meter of the flat is in range of 48,000, 49,000 to 53,000 rupees. So valuer, as a valuer, we can assume any amount we can assume. So we can easily assume 53,000 rupees of per square meter. We can also assume 49,000 rupees if we are a little bit conservative. So 53,000 rupees per square meter is okay. So market value of the flat is 65 square meter, which is area which is given in the question, into multiply by 53,000 rupees per square meter of rate, property rate, which we have calculated through this technique. So total value of the property is 34,45,000. That is the conclusion. So before we move to the, I'll tell you about the next sessions, what exactly we are going to cover in subsequent 3 sessions of this series of market approach to value. I would request you to please subscribe to the channel and click on bell icon so that you will be immediately notified about upcoming videos. So upcoming session number 3, we are going to discuss about various techniques of development methods and residual methods. So these 4 methods we have little bit discussed about these 4 methods in session number 1 of this series. We will have discussion on these concepts along with theory and case study and examples in upcoming session number 3. So session number 4 we will discuss about hypothetical plotting method, and we will cover all these 5 methods. A numerical may come or case study may come out of these methods. And in last session we will discuss about various concepts, theories and case studies of joint venture. So keep watching. Thanks for watching this video. Thank you.